Welcome to Breaking News to Trading Moves. Usually when we talk about a medical diagnosis, there is this expectation of precision. It feels, well, clean.
Right, it is very binary.
Exactly. You break your arm, you go to the hospital, and the x-ray shows that jagged white line on the screen. The doctor just points to it and says, there is the problem.
Yeah, broken or not broken. You look at the image and the reality of the situation is indisputable.
And you know exactly what the path to recovery looks like.
Which is comforting. I mean, human beings love that. We like things to be visible, to be categorized, and to have a definitive solution.
But then you step into the world of financial markets, and suddenly that x-ray machine is just broken. You are staring at a screen, but instead of a clear picture, you're looking at a landscape of human execution that is, frankly, entirely murky.
Oh, completely murky.
The struggle between human psychology and market execution is the core tension we are examining. The central question we have to answer is this: is the path to consistent trading found in building rigid, systematic, process-based rules to bypass human emotion entirely? Or does success require a discretionary approach grounded in adaptable, probabilistic thinking?
Right. The machine versus the mind.
Yes. And I take the position that human cognitive biases make discretionary trading inherently flawed. Because our biology actively works against us. Only systematic frameworks and strict process metrics can generate consistent returns.
And I maintain the opposing view. Relying on rigid, automated systems introduces fatal real-world limitations. Instead of trying to outsource our discipline to a machine, cultivating a probabilistic mindset combined with discretionary judgment is the superior approach.
Well, let us start with the severity of human cognitive failure in markets, because it simply cannot be overstated. When you look at the literature, it shows that 80 to 90% of trading failures stem directly from psychological factors.
80 to 90%. That is a massive number.
It is. It is almost never a lack of technical knowledge. People understand what a trend line is. What they fail at is managing their own minds. Consider the disposition effect.
Yes.
This is a well-documented cognitive bias where loss aversion forces humans to sell winning positions too early and hold losing positions too long.
Right. The classic scenario of cutting your flowers and watering your weeds.
Precisely. Let us break down why that happens. Prospect theory dictates that the pain of losing $100 feels mathematically worse to your brain than the joy of making $100.
We are wired to secure a sure gain, to get that immediate dopamine hit.
Yes, and we avoid finalizing a loss because hitting the sell button makes the failure real. But it is not just behavioral, it is biological. The release of cortisol and testosterone under financial stress compels us to take impulsive risks.
So the body is actively working against the trader.
Exactly. Cortisol, which is a stress hormone, directly increases your preference for risk when you are cornered. Meanwhile, testosterone encourages overly optimistic expectations about future prices. You have a physiological cocktail that is designed to ruin your trading account.
It sounds like a trap.
It is. To survive this, we must rely on systematic trading, quantitative rules, and strict adherence metrics. We have to remove flawed human intuition from the equation entirely.
Well, I come at it from a different way. I absolutely acknowledge the reality of those psychological biases and the biological responses. You feel your pulse in your ears when a trade goes against you.
You really do.
But relying purely on systematic trading creates a false sense of certainty. I mean, models suffer terribly from overfitting and data snooping bias.
You are referring to strategies that look perfect in a simulation but fail in reality.
Exactly. You can build a mathematical system that looks flawless on historical data. You are essentially tailoring a suit perfectly to the weather of a specific day in the past.
Right, but the weather changes.
It changes constantly. Smooth historical backtests routinely encounter monstrous real-world challenges. We're talking about execution realities like slippage.
Ah, slippage.
Yeah, in a backtest, you get filled exactly at your target price. In the live market, there is a gap between the expected price and the actual execution price. You also have sudden changes in market context, volatility spikes, sudden liquidity drains that algorithms simply cannot read.
But an algorithm does not panic during a liquidity drain.
True, but it cannot adapt either. The ultimate edge is not a robotic system. The ultimate edge is a human operator who has mastered the law of large numbers and treats the market probabilistically rather than deterministically.
I hear what you were saying about the pitfalls of poor modeling, but let me give you a different perspective on how those psychological failures manifest mechanically on the screen.
Okay, go ahead.
To understand why a systematic approach is necessary, we have to look at the destructive nature of overtrading. The data reveals that trades taken after the third trade of the day often carry a negative expected value.
Meaning, the more you click the mouse, the more money you are statistically guaranteed to lose.
Yes. The numbers show that overtrading increases monthly losses by 23%. Why does this happen? Because humans are narrative machines. We crave causality.
We want a reason for why we lost.
Exactly. When a trade goes against us, the ego is bruised. It demands an immediate narrative to fix the pain. That leads directly to revenge trading. The ego refuses to accept responsibility for a probabilistic outcome.
So it blames the market makers, the Federal Reserve, or the broker.
Right. It forces you to jump back into the market to win back your money and your pride.
That ego response is undeniable. The psychological strain of a drawdown is immense. When you are staring at a sea of red, logic often goes out the window.
Which is why systematic backtesting is so crucial. It removes the ego entirely. Think of systematic trading as an aircraft's autopilot.
Okay, an autopilot.
Yes, building a robust autopilot requires rigorous out-of-sample testing and exceptionally high-quality data. You even have to include data from bankrupt companies in your testing to ensure a realistic assessment and avoid survivorship bias. You do not just test on the companies that survived.
Right, because ignoring the failures distorts the probability of success.
Exactly. But once that autopilot is built and engaged, it reliably prevents the pilot from making fatal, fear-driven errors during turbulence.
Assuming the autopilot does not malfunction.
When a human pilot hits sudden violent turbulence, their heart rate spikes. They might panic, grab the yoke, and overcorrect, putting the plane into a dive. The autopilot does not feel fear. It just reads the altitude, adjusts the flaps, and maintains the course. The system executes the rules without feeling the sting of the loss.
Well, I am sorry, but I just do not buy that. Let me tell you why. That autopilot is never as invulnerable as quantitative modelers want to believe.
How so?
The material highlights an exact example of this. A strategy with a 98.7% win-loss ratio in backtests that turned out to be nearly break-even in live trading.
A 98.7% win rate dropping to break even is a drastic failure of the model builder, not necessarily the concept of modeling itself.
But why does that happen so often? Because systematic approaches cannot fully account for the nuance of live execution. A backtest cannot feel a requote.
True.
It cannot perceive a sudden liquidity void where buyers completely vanish. When a sudden news event hits the wires, an algorithm just executes blindly based on its historical parameters.
It follows the rules it was given.
Yeah, it will happily buy into a falling knife because the code says the asset is oversold. A human operator can pause, evaluate the context, and adapt to the immediate environment. A fixed set of code cannot perceive fear. The market is not a sterile mathematical environment. It is a living auction driven by human behavior.
But relying on a human to interpret that living auction in real time introduces the exact cognitive errors we just discussed.
I disagree.
When a trader is experiencing fear, their neurobiology alters their decision-making. The amygdala, which is the brain's fear center, and insula light up. This signals risk and loss salience, making immediate losses feel far more powerful to the brain than equal gains.
Sure, the brain reacts.
So how can an operator be adaptable and objective when their own brain chemistry is actively working to paralyze them?
Let us look at the actual execution tools systematic traders use to build these autopilots to answer that. There is a massive over-reliance on technical indicators.
Indicators are a foundational tool.
But look at how they are used. You see systematic models built on combining the 9, 22, and 200 period moving averages. They create these elaborate crossover rules. But these indicators are strictly lagging. They synthesize past information.
They smooth out the noise of the price action.
They tell you it is raining after you are already soaked. Discretionary price action, on the other hand, allows a trader to read the psychology of the market in real time without the lag of an indicator.
But that is incredibly subjective.
Human nature is predictable. A discretionary trader can anticipate psychological levels of pain in the market structure, whereas a moving average is just doing math on what happened 10 minutes ago.
I understand the theory behind reading the tape, but can you give a concrete example of how that works in practice? How does a human outperform a calculation?
Absolutely. Let us say you are watching price action and you know where institutional funds might have a 5% stop-loss trigger.
Okay, a known level of pain.
Right. Maybe you understand the specific level where a large fund's tolerance for risk breaks. A discretionary trader can watch the volume accelerate as price approaches that level and capitalize on that panic the moment it happens.
You mean shorting into the cascade?
Yes. They can short into the void as the stops are triggered. A moving average indicator will not show you that panic until the move is already over and the price is settled. You need a human interpreting the fear of other humans.
That is a compelling argument, though I would frame it differently. The problem with pure price action is that it is entirely subjective and mostly untestable.
Untestable does not mean unprofitable.
When you rely on something that cannot be rigorously quantified, you leave the door wide open for emotional bias. You see a pattern because you want to see a pattern, not because it is statistically valid.
That is where the probabilistic mindset comes in.
So I have to ask you, if you rely purely on discretionary judgment, how do you prevent the ego from demanding to act as an oracle, constantly adjusting risk based on gut feeling rather than statistical reality?
By recognizing that true mastery is internal. The amateur ego wants to be right on the very next trade. It wants to predict the future.
Always chasing the next win.
Exactly. But the professional discretionary trader has surrendered the need to be right on a single instance. They have accepted the randomness of the moment.
Well, I am not convinced by that line of reasoning, because internal mastery is incredibly fragile under physiological stress. We need verifiable process actions to anchor the trader when their brain goes into fight or flight.
Verifiable actions? Like what?
This brings me to a concept from the academic literature called the discipline coin, or the DISC.
The discipline coin. How does that operate?
The literature calls it an intrapsychic cost-free metric. Let us translate that. It is essentially a mental scoreboard that costs you nothing to use, and it tracks your behavior, not your bank account.
Okay, go on.
You reward yourself purely for time spent adhering to a pre-specified strategy. It is completely decoupled from monetary outcomes.
So it is essentially a mental tally of good behavior? A way to keep score of your patience?
Precisely. You earn a coin for strict adherence, not for making a profit. If you spend an hour executing your plan flawlessly, even if the market stops you out for a loss, you get a disc.
And if you deviate?
If you break your rules and take a rogue trade, you do not get the coin. The coins you have already earned stay in place as a permanent record of disciplined behavior. Focusing on verifiable process actions like the disc is the only way to build consistency. It operationalizes process fidelity.
It takes the focus off the profit and loss statement.
Exactly. It reorients the trader's attention away from the flashing red and green numbers and toward procedural consistency. It provides an objective anchor when the market induces panic. It gives your brain a different metric of success to chase.
Well, that is a very structured mechanism, but I embrace the need to divorce execution from the monetary outcome without needing to gamify it in my head.
Gamifying it works for human psychology.
But achieving that detachment is an internal, philosophical achievement. It is not something that requires an algorithmic track record or a mental token system. Think about the simple coin flip analogy.
Okay.
If a strategy has a 60% win rate, getting 3 tails in a row does not mean the coin is broken.
Right, the law of large numbers dictates that the edge exerts its power over time, provided the sample size is large enough.
Exactly. Yet 90% of traders fail because they demand certainty right now. They treat every single entry as a personal referendum on their intelligence.
They want to be proven smart immediately.
Yes, they demand validation from the outcome of the next tick. True professional competence is incredibly boring. The professional trader views a loss merely as a statistical verification fee.
A verification fee?
It is a business expense. They accept the absolute irrelevance of the single trade. When you internalize the law of large numbers, you do not need a mental token to stop you from overtrading. Your edge exerts its power over time, and the single trade is just noise. The system is the signal.
I completely agree that deterministic thinking is the enemy here. Craving certainty in an uncertain environment is what destroys trading accounts. But arguing that a trader can just adopt a philosophical detachment ignores how human biology operates during severe drawdowns.
You think philosophy fails when the money's on the line?
The evidence shows it does. We have real-time field measures showing heart rates and electrodermal activity, literally the sweat on a trader's skin, spiking during active trades.
Physical stress markers.
Yes, acute stress amplifies domain-dependent risk biases. Our prefrontal areas, which handle logic and strategic control, get completely overwhelmed by anticipatory reward signaling in the nucleus accumbens, which is essentially the brain's craving center.
So biology overrides logic.
Because of this biological stress response, traders need external architecture, not just mindfulness.
What kind of external architecture are you referring to? Are we talking about software?
Yes, we need platform-level safeguards. Hard daily trade limits, kill switches, and pre-session checklists act as circuit breakers.
Checklists?
The data shows that skipping a pre-session checklist increases the likelihood of overtrading by 3 times. Taking just 2 to 3 minutes before a session to verify daily loss limits and assess your mental state is a mechanical safeguard.
And the kill switch?
Probabilistic mindset. A kill switch will save your account. It physically locks you out of your trading platform when you hit a specific loss threshold.
It forces you to stop.
Why does that work? Because it physically interrupts the biological loop of the amygdala hijack, forcing the brain to cool down before more capital is destroyed. Philosophy will not do that. We see proprietary trading firms using these exact tools, hard limits and automated risk management, to prevent their traders from blowing up their accounts.
Well, I do not dismiss the utility of a kill switch for a novice who is just learning how to handle the pressure, but the danger is that external restraints prevent the trader from developing internal regulation.
How so?
If the software cuts you off and locks your screen, you have not learned discipline. You have just been placed in a digital timeout, but it preserves your capital for the next day.
It does, but it stunts your growth as an operator. The goal is to reach a state where you experience the loss, recognize the urge to revenge trade, feel that biological spike in your heart rate, and consciously choose to step away.
That is a very high bar.
You do that because you understand the outcome was probabilistic. You cannot learn this by reading about candlestick patterns or relying on software to lock your screen. You learn it by sitting through drawdowns, feeling the pain, and executing your plan anyway.
But the reality is that the vast majority of people never reach that enlightened state. The attrition rate proves it. If 90% of traders fail, relying on internal regulation is statistically a losing bet.
It is difficult, but it is necessary. We must structure the environment to prevent the failure, because the human mind cannot be trusted in this specific arena. Even Frazzini's study on the disposition effect recommended a quantitative trading strategy.
Oh, really? How did that strategy function?
It involved going long on good news stocks with large fund overhang values and shorting bad news stocks. The reason it worked is because it mathematically exploits the fact that human mutual fund managers cannot overcome their loss aversion.
So it profited from their hesitation.
Yes, the math capitalizes on the human failure. The failure is so predictable that you can build an algorithm to profit from it.
That is a compelling application of the data, but it assumes the market remains static enough for the math to always work. Markets are not deterministic math problems.
No, they are not.
They are essentially random number generators at the micro level. When you try to force certainty into a system built on uncertainty, you break the system. You are trying to predict the unpredictable with rigid rules. The operator must manage their response to randomness, not attempt to control the randomness with code.
I see your point. We do arrive at a strong point of convergence here, though. The craving for certainty and the fixation on short-term profits are the ultimate destroyers of trading capital.
Yes, absolutely.
We both agree that true edge lies in flawless, emotionally detached execution over a series of hundreds of trades.
We absolutely agree on that. The thrill of being right has to be sacrificed to achieve consistency. When trading becomes boring, you are finally doing it correctly. It should feel routine, not exhilarating.
Where we diverge is the mechanism for achieving that flawless execution. I maintain that because of our cognitive and physiological limitations, our cortisol responses, our loss aversion, our constant need for narrative causality, consistency demands rigid, systematic rules.
And the platform safeguards.
Yes, it demands automated kill switches that sever the biological loop, pre-session checklists, and strict process metrics like the discipline coin. We simply cannot outthink our own biology when the pressure is on.
And I hold that markets are living, probabilistic environments. The highest form of trading requires an adaptable, emotionally intelligent human operator who accepts uncertainty without the need for artificial training wheels.
The machine versus the mind once again.
Exactly. The mastery of trading is the mastery of self under conditions of extreme randomness and financial stress. You cannot automate true mastery.
Examining this material through both a mechanical and a psychological lens provides a clearer picture of what it takes to survive in the markets. We encourage you to evaluate your own routines. Are you trading to satisfy your ego, or are you trading to execute an edge?
That is the ultimate question every operator must face when real capital is on the line. Are you trying to prove you're right, or are you trying to manage probabilities?
Just like that broken X-ray machine we talked about at the start, the market will never give you a perfectly clean picture of what happens next. The clarity has to come from your execution. Welcome to the reality of trading.